Madam President, tonight at our workshop, we'll be presenting our 2021-2022, or also known as FY22 budget, and I'll turn it over to my colleague, Mr. Brown, our CFO.
Good evening, board members.
Good evening.
Hope you all are doing well. And this is our time of the year where we present our annual budget to you for review and approval. And just a review of the process on how this works. The state opens what we call a Cycle 1 window. They open it the 1st of September, where we can work on posting this Cycle 1 budget. We can create it in our software, create the reports for you, and then we have to post this to ADE by September 30th. So typically the last week in September is when we present this to the board and you all approve this. So this is I just also want to tell you that the budget is a working document. This is the funding that we are aware of that we're receiving at this time. We receive funding throughout the year for programs that are not yet disclosed to us. For instance, ELL, we receive that funding, but that doesn't come to us till December. We receive funding for National Board Certified Teachers to receive bonuses. That hasn't yet come to us. We receive literacy grants. We receive high gains grants. Crestwood's been a recipient of that in the past. So as we get things throughout the year, our budget will increase because we have additional funds to spend. So this is a snapshot as of today. You all are approving the framework, and then as we get additional monies throughout the year for different reasons, we'll add that to our budget. So if you have questions along the way, please stop me, please let me know. I'll be glad to explain anything that you need an in-depth explanation of. I'll try not to assume that you know some of the finance terminology. I'll try to explain that to you. And I guess I broke that rule first off by saying cycle report. Cycles are reports that we, the district, are required to file with ADE almost on a monthly basis. There are 9 of them throughout the year. And I do cycle 1, which is the budget. Kathy Hale does cycles 2 through 7. I pick back up with cycles 8 and 9. That's when we close out the final budget for the year. So when I say cycle report, I'm talking about the reports we have to submit electronically to ADE to show them how we're budgeting, how we're spending that money. So, all right, so on the second slide of your presentation, we'll just review some terminology. We have you'll see terms in here like revenue, and that's money we receive in. Expenditures, money we're paying out. Bonded debt, that is our debt payment, and that's associated with our millage that for the building of our new buildings and renovation of the new buildings, our whole building program. You'll see the words transfer. That's not an expenditure and that's not revenue. That's just moving money on the books between two funds. The types of revenue that we're going to cover right now will be local revenue, state revenue, federal revenue, and other revenue. So state and local revenue are recorded in Fund 2. So on the board report that I give you each month, that starts with Fund 1, continues with Fund 2, Fund 3, 4, 5, 6, 7, and 8. All of those numbers mean something. Fund 2 is your local and state. Fund 1 is a teacher, certified teacher fund. That means if we're paying a licensed teacher out of operating, it has to come out of Fund 1. Fund 2 is for revenue is going to be local and state. Fund 6 is federal. Fund 3 is our building program. That's where we keep money above our $12.8 million in the savings for us to handle any type of building repair, renovation, new construction, whatever the board deems is a priority. Also, bonded debt payments. All of our bonded debt payments come out of Fund 4. So If it starts with a Fund 4, that's related to bonded debt. Fund 8, that last one on there, it's clipped off the screen, but it shows on my screen here, is child nutrition. So anything regarding child nutrition comes out of Fund 8. So here's some example of sources for local revenue. We have property taxes, we have land and facility sales, we have 98% uniform tax rate guarantee. That has to do with the collection of taxes from our local tax assessor. And part of the adequacy study, if you remember back when the adequacy commission was formed in Arkansas, they determined that education wasn't being funded, equally and equitably. So one of the items that they developed as part of that commission was this 98% tax guarantee. So what that means is we have a millage of 48.3 mills. The state requires that we have a minimum of M&O of 25. That's the minimum a school can have and exist. So what they do, the state kicked in and said, we're going to guarantee funding on your tax base for the 98% of taxes, whether it's personal taxes, real estate taxes, utility taxes. We're going to guarantee you tax money to run your school at the rate of 98%. If you collect less, we collect at 95%, the state kicks in money to make us whole to 98. If we collect 99% on the first 25 mills, we have to pay 1% back to the state. So the balancing act there is 98%. So they use that balancing act to make sure that school districts that are small, that may be having a problem collecting taxes, are guaranteed that revenue to run their school. And that became part of the adequacy study years ago.
Okay, can you cover the payback 1% again? Because I was thinking
Yes.
when you said that.
So it works both ways.
Okay.
We're guaranteed 98%.
Right.
They guarantee us, so they'll pay us for years. So let's say we have 5 years where we have less than 98. They're going to make us whole on that.
Okay.
But in the event that we collect more than 98% on the first 25 mills, we have to pay that to ADE. So they will make us whole, but if we collect more on the first 25 mills, they take it back.
Doesn't that all come out in the wash when it comes to foundation funding anyway?
It's your taxes. This 98% guarantee is in the foundation funding. So the foundation funding line in there, if it's negative, you've collected more than 98 and you owe them money. If it's a positive number, then you've collected less and they owe you money.
Okay, I guess I'd have to look at it, because I would think that at the end of the day, they guarantee we get a certain amount per student, right? And they cover the gap. And I don't
Correct.
see, I would think this 98% just kind of plays into that final number.
It plays into the number on the first 25 mills, and that's sort of the guaranteed baseline that school districts are guaranteed by
Right.
ADE in that tax base.
Because we don't even collect the taxes, the county
Right.
does, so.
Now, if we collect 95% of our taxes, the difference between the 25.1 mills up to 48.3.
That's on us.
They don't guarantee that.
Right.
So we get just less
get what
money
we
to
get.
pay our house payment, our bond
Gotcha,
payment.
gotcha. Okay,
So, yep.
thank you.
Yes, sir. So the first category there is local revenue, and that will, for the fiscal year 22, that totals to $36,988,104. That's local and state. I'm sorry,
Local.
that's local. The state revenues are the foundation funding, ABC, the 98% collection guarantee, the ESA, the debt service, the professional development, mentoring. These are all examples, but there are a lot more. ALE, all the categoricals, all of those fall into this section. And I want to also say that tied to this section is your 3/4 ADM. Okay, and you all have seen this 12-year graph before. I've put it in your weekly board reports and a couple of times, and we've discussed it, I think, in a board meeting since we got the numbers for fiscal year '21. But this is our 12-year trend line, and 3/4 ADM, and ADM stands for average daily membership. So that's the number of kids that are enrolled in your district. And a lot of people get that confused with ADA, average daily attendance. So kids that are absent but are enrolled in our district still count in our funding formula. So it's average daily membership, it's the kids that are enrolled in your district. And you can see we were at 8814 in 2010, and in 2021 we settled at 7550. And if you'll notice, that was a drop here. From 20, which was 8,017, to 21, 7,550. That's a drop of over 400 kids in enrollment. So they either stayed home, didn't come to school, they went to a private school, they didn't enroll with us.
I know that's not what this is about. Do we know what percentage of the students fall in those different categories? As far as, did we lose them to other districts? Are they just staying home and everybody's having this problem? And I know this isn't your wheelhouse.
It's not mine. I know Mr. Stone has been, I know we've had that conversation with him on trying to dig in. Now, I know there are some principals, some building principals that do know. In particular, at Lakewood Elementary, the principal there can tell you every single student that left and where they went. So there are reasons that principals may know, and reasons that principals may not know. But I know that we've had that discussion with Mr. Stone about student services stepping in there to do an analysis to see if there's a trend. And I don't, Dr. Paluski, is there?
Yeah, the only thing, just a couple things. One, I think every school district has experienced declining enrollment, unfortunately.
Okay, so
some of
this
that
is
due to the
across
pandemic.
other districts are seeing this.
Absolutely, and that's nationwide. Hanover Research, as an example, one of the reports they put out of the top 3 things concerning superintendents across, number 1 is enrollment. The second thing, which I find interesting about this, is we've been digging into this as an executive team, and I've asked the same question: what percentage of our kids are going to private school, which are being homeschooled, how many of those students have moved out of state? One thing to share, as we've been talking with Ridge Road Elementary, and I think they're down about 35 students, in speaking with Mr. Howe, the majority of those students have gone to Lisa Academy. So those, as we start to kind of unpeel why are families moving maybe to some of these because of school choice, for what reasons. So we're going to continue to unpack it, and I certainly is going to be one of our challenges of, and certainly my challenge of increasing enrollment as we move forward.
Okay. Yeah, I mean, I don't recall any of the local charter schools requesting substantial increases in the number of students they could hold. So that's why I'm curious if all the public schools are seeing these kids go, they've got to be going somewhere. Lisa and the other charters are not absorbing all these kids. So I know it's a huge
one
undertaking.
school, but correct, they're not absorbing
huge
all of them. But if you look at that one school, they have been greatly impacted by,
Okay.
just to give an example.
Can I pause? JT, I'm going to use your memory for a second. 2010, was that Curseful? I'm talking superintendent. How long did we have
yes.
Rogers versus Ackland versus,
Well,
that's what,
So Kirschville was in 2011. I think Mr. Rogers came on in 2012, if my memory is correct. I came onto the board in 2011, and we hired him soon thereafter. So I think he would have started in 2012. But
okay, and then.
I don't, after 2014,
I think he came on in 2013. I think, and the reason I know is I came to finance in 2000, the school year 2013.
You may be right.
And Mr. Curseful
Was
filled
here.
in for me at the high school.
Because the vote was 2012 for the millage increase, so
Correct.
it was Kirschville through that. So you're probably right. It was later. Yeah.
Okay, so when did Rogers exit and Ackland come in?
That I don't know.
2017? Brian, do you know?
I don't
I'm just
know
trying
that
to
I can-
gauge superintendents with numbers is what I'm doing here. I'm relating.
Ackland came the year that we got on the board. He came the same year. 18.
So we came on the board in 2018,
Yeah,
Well, he was
18.
temporary, and then y'all made him permanent.
but that was in October. It all happened right at election. He came on during the summer of 2018. They made him permanent in October, and we came on in November.
So we've had the biggest decline with Akron. Who was before Cursville?
Before Kirsten.
Mr. Smith?
Mr. Smith, and
Smith,
that's been
that's
good long back.
Well, it was, there was Tom Kimbrell.
That's right.
Oh, Tom Kimber, I
Yeah, Tom
forget.
Kimball for a
Kimber was
short
here
period
for
of
6
time.
months.
Mhm.
Now you have to ask her memory.
And
When
then
I
Mr.
left-
Smith prior to that. I'd have to brush up on
Yeah,
that.
that's-
but
that's-
do
When I
know.
got off the board, Cursville, I was here for Smith, Kimbrell, and Cursville. And when we put Cursville on the board, that's when I got off.
Gotcha.
I'm just relating superintendents to the numbers is what I'm trying to do real quick.
Sure.
Okay.
So, the point I want to make there is that decline 2020 to 2021, that's reflected in our fiscal year 22 funding. So, the next page you'll see is the state funding total, and that is $47,162,959. And if you're looking at that electronically, I've got a link here to the state aid notice that we can click on. And if you're looking at the hard copies, it's the page that looks like this in your supporting documents. So that is our, this is our state aid notice. And if you'll notice the top, in between those top two lines are information about our districts. So you'll see there's a 2020 real assessment value for the district, personal property assessment, utility assessment, and a total assessment. We had an increase of about 2% in our total assessment. So your tax dollars figure into your state aid notice. So while we had a decrease in student enrollment, we did have an increase in our assessment, which equates to more tax dollars, more guaranteed by the state. So there's a little bit of an offset, but not too much, because our assessment was growing at the rate of 2%. But if you'll notice here on line 28, starting on line 28, that line starts the funding amounts. That's the state foundation funding. The amount per student is $7,182. And if you'll notice in the third column, those are the associated laws and acts that apply to the state foundation funding. And if you'll notice over here, these two columns, the revenue code, let me see if I can open this so I can. Highlight these for you. So in the two right-hand corners, you'll see revenue code, and you see it begins with a 3. That means state money. And you also see source of funds, so this 2001 means on your board report that you get monthly in your packet that our state foundation money goes into 2001. So this sheet is important for finance. It tells us how much to budget, for the ensuing year. And just one interesting note, if you'll note at the top of this, you'll notice the date it was published. This is the first preliminary state aid notice. It was published on July the 28th, 2021. And we began the year July 1, 2021. So we start the year without this funding sheet. Now you can look back at cycle reports, you can make comparisons and projections, and that's what I did for you all on the ADM. I monitored our cycle reports, because every cycle report, every report that we send to ADE on a monthly basis, we send student enrollment. And they calculate that, they keep a running total of that. So we can look at that and make a projection on where we're gonna end up. If you'll notice line 10 is that 75,550.91. That's the last number on that 12-year trend graph. There are also categorical funds on here. alternative learning environment, $4,794 per student. We're receiving $863,785. Now that's based on not your total enrollment, that's based on your alternative learning environment student enrollments. So for every child that attends alternative learning education for full-time, all year, 178 days, all 8 periods of the day, that generates $4,794. If they're placed late or they're dismissed early and they attend part of the year or they're a partial day student, you get an FTE fraction of that amount. They prorate it.
And that's in addition to that $7,182.
Correct. That's correct. The line 32, English language learners, we get $359 per ELL. Now, line 31, ALE, that's based on the number of kids that were in the program last year. ELL is a current year number. That's one of the examples I gave earlier that I said today is a snapshot of the budget. We won't get this number until December. They'll do a December 1 child count on ELL students. They'll figure this, and there'll be another preliminary budget they release in January that'll pop that number in there for us. So they'll look at this, they'll count our ELLs, and they'll assign us funds for those students.
The ALE money, to clarify, there are rules regarding the ALE environment.
Correct.
As far as class size that cause that cost to be higher. And I mean, that's why we create that environment for those students. It's needed.
Correct.
But just for anybody who's watching, that's not just free money we get for putting kids in ALE.
No.
There's a cost associated with that environment, and that's why we get that money.
That's exactly correct. They do require, in regular ed, you can have 30 kids in a regular education high school classroom. In ALE, you can have, I think, 15. With an aide, you can have 17. They require smaller class size, so in return, you're gonna end up spending more money for staffing to man the school. So you're exactly right. This funding is what we call categorical funding, and it is restricted. It is only available to the alternative learning environment. We spend 100% of this on salary and fringe every year, plus we transfer ESA funds to fund the additional costs of the program. So we spend every penny of ALE money every year, and it is restricted for ALE use only.
So would you say we're in the red during the ALE program then?
Well, in categorical funds, you can transfer between them. So ESA is our largest category of funding in the categoricals, but we also have PD, we have ELL, we have ALE. So you can transfer money from ESA over to help ALE. You can transfer money to ELL to help ELL, and we do that as well. So we spend every dollar we get on the categorical ELL fund, and we transfer money from ESA to help fund that. Occasionally, we spend all of our PD money, and we transfer money from ESA to PD to help balance that to zero. So yes, what they do is, so ADE, if you spend $1 on ALE, they want you to pay it out of the ALE fund so they can track it. So yes, we spend in the red, but at the end of the year, we transfer from ESA to make the balance zero.
Gotcha.
And we do that at ADE's direction.
It's baked in, basically.
They want to track all of your expenditures, and so an expenditure in ELL is for ELL, an expenditure in ALE is for ALE. You can overspend, but you can transfer from ESA to offset the costs.
Okay.
Here's the ESA line. We get $5.988 million. If you'll notice in parentheses, there's 3 different numbers. There's a 532, there's a 1,063, and a 1,594. Those are different funding levels that are based on your free and reduced lunch rate. So we hit the 70% mark years ago, and we were locked in. We're now under CEP. We're locked into that 70% rate for a period of time. So we're at the $1,063 per student funding level. So, that 5,988,000 is based on the middle, funding amount per student.
Brian, how do you,
Yes.
if you can transfer money from ESA for those other programs, how do you keep from spending all of ESA? Like, do you just do it throughout the cycles when they go in the red, you go ahead and transfer the money then, or?
So Christy Ratliff and I we schedule transfers. So we look at all the salaries. We can predict what all the salaries and benefits will cost in ALE. We know how much money we're getting in ALE. We can predict our overage. So we go to ESA and we schedule a transfer, a move of that money. So that money moves it from ESA over to ALE. So to answer your question, we have to budget and we have to schedule transfers. And that, when you schedule the transfer, it makes it unavailable in ESA.
Okay,
And that keeps us in balance with all the funds.
okay, all right, thank
Yes.
you.
Yes. Professional development, here a moment ago I mentioned that. We get 200, that's a categorical. We get 271,000, that's $36 per child. Bonded debt assistance, $99,000, that's $18 per child. Declining enrollment, so this is the line, this is an important line for you to be made aware of and to know what it means. So the 12-year graph where we saw the 400 student decline, the decline in ADM, that's 400 students, approximately $3 million we lose in foundation funding. The state has a safety net, and it's a short-term safety net. So what they will do is they will fund your decrease in student population, in student ADM, at half of what you lost. So we lost $3 million this year in foundation funding. They're funding us $1.6 million. They know that we have teachers that are contracted employees. They know we have planned expenses. And it takes time to plan to reduce expenditures or make alternative arrangements for expenditures. So they fund us at half of that reduction. So that's where the 1.6 comes in, but that is temporary. So at some point, if we don't get our students back, we will realize the full $3 million reduction. Okay? So I just want to point that out. All right, so this is our foundation funding. Again, the information between the two lines at the top is data related to our data, and the information below the bottom two lines there is funding based on state sources. Okay. Next, we have federal revenue. And there are several sources of federal revenue. We have Title I, Title II, Title III, Title IV. Those are in Ms. Ratliff's wheelhouse. Then we have Early Childhood Special Ed, Medicaid Catastrophic, RMAC. Those are in Ms. Alexander's wheelhouse. We also have a JROTC program. That's a federal fund where we are reimbursed by the Army a percentage of the cost of those JROTC employees. We also have a career and technical program, Carl Perkins. That's also a federal fund. Our federal funds this year are $51.4 million. And I just want to point out here that that is an inflated number. We usually see around 14 to 16 million in federal funding. But that's because of these two. I didn't label on the other slide, but ESSER 2 and ARP ESSER funds and ESSER 1 were all part of the federal programs. They begin with a 6. So these are one-time monies. So that is, it looks like a lot. It is a lot of money, but it is short-term and it's one time. So we have to keep that in mind. Fund 7s are all activity accounts. So your principals at the schools, they may have a lounge account where they get a commission off of selling Cokes out of the Coke machine, where they spend on their teachers. You may have a school store. You may have a beta club, you may have a cheerleading account, you may have a basketball, boys and girls basketball activity account where they do fundraisers. All of those are examples of activity accounts. In your board report that you get monthly, those begin with the number 7. And that is where we do small transactions that are related to fundraising of some type. Now here I've added an additional column. So this FY22, the right column, is where we were. We were at 36.6 on the first line for local, 47.1 for state. We had 51.4 for federal, but if you subtract out that 37.4 in ESSER funds, that gets you back down to the 14 million that we are used to seeing in our federal budget. Also, we have 350,000 scheduled in all of our activity funds, and I've got the left column there is fiscal year 21, just so you can compare. So fiscal year 21, the local property tax, you can see we had 35.6 million budgeted last year. We're budgeting 36.6, and I mentioned to you that there was an increase in assessment, which equates to an increase in tax dollars. Here, the state foundation funding, this is 48.9 million. This year, we're projecting 47.1 million. That is the loss of 3 million, but the adding in of that declining enrollment, 1.6 million. So just the simple math, that's the difference between those two numbers. Everything else basically stayed the same. There was some small increases in per pupil funding. Federal, we had 14.7, and again, we have 14 million when you subtract out the ESSER. And then we projected $500,000 last year, and I think we actually collect the actual, and that was 300,000. So we budgeted 350 this year. We thought there may be a little more activity with people getting back in the routine of things. So the total is 99.8 million for fiscal 21, FY21 budget, and then FY22 budget 98.2. So a slight reduction, but that is related to the reduction in ADM. So I've got you some percentages here. So some of the things that the public may ask you, some of the big picture funding questions someone may ask you is how much federal dollars do we get in the state? That might be something they ask. How much do we get in local funding, like taxes? How much of that money comes out in the wash on your budget? So local, now this first group here is with ESSER. So local is 27%, state is 34.8%, federal is 37.9%. But if we take ESSER out of the picture, local is 37, state is about half, 48.1, and federal is 14%. So you can see the biggest source of funding for us is state at about half, and then local is about 37%, and the remainder, federal, is 14%.
Quick question. On that state number, we pay them money, and then they pay us money back. So is that state number deducting the money that's collected on our first 25 mills, or is that the full 7,100 in foundation?
So the foundation funding line in that state aid notice takes into account the plus and minus on the 98%. So
Okay.
they
We don't ever get the money.
Yeah.
I get that.
Yeah,
But that's there's supplemental money. That's not the money including what's already been sent in. Okay, thanks.
So here's a graphical representation, just the percentages that we talked about with ESSER here. Federal is 37%, 27% local, 34% state. Without ESSER, about 50% of our budget is state funding. Federal funding is around 14%, and the local is about 37%. Okay, so that's the revenue. Now on the expenditure side, if you recall, the expenditure document that we went through line by line back in the spring, Those are account codes, and that is a summary that you'll see here. It's summarized by account code. So all the 61,000s are salary. If it begins with a 6-1 on your report, it's a salary. If it begins with a 6-2, it's a benefit. If it begins with a 6-3 or 6-4 or 6-5, it's what we call a purchase service. That means we're paying somebody to come do something for us. We're not paying an employee, we're paying an outside entity to come do something for us. Or we're paying utilities, which is a purchase service. Materials and supplies begin with a 66. Capital outlay, which is a fancy term that means equipment that costs more than $1,000 individually. So that's capital outlay. If it costs more than $1,000 individually, we have to keep that, an inventory of that, and we have to keep a record of that in eFinance, track its location. And then 68,000 are other expenses.
So the capital outlay, the equipment, would that also be the programs that we purchase, or this is
Could be.
actual equipment? Okay,
It could be if it is a physical object that we're buying. Let's say we're buying a new van because the maintenance van was totaled in the accident.
sure,
That's gonna be a capital outlay.
okay.
But we're paying $2 million to Pearson.
Mm-hmm.
That's to provide an educational service for our kids.
Right.
That's not an object, that's a professional service, so that comes under a purchase service.
Okay.
So if it's an object that we're buying that's tangible, that costs over $1,000, it goes into the capital outlay. If it's a service that costs more than $1,000, it goes into purchase services.
Okay, so what about all those computers that we purchased for the 3D models of like the heart diagram? Remember when we did that 2-3 years ago?
Mhm.
Where did that lay? Cause
So-
I see that as both.
It depends, so the rule is,
Okay.
if the computer plus the tax, plus the shipping is $1,000 or more per unit, it has to get coded into the capital outlay. So if it's under $1,000 each, it gets coded in the 66 line. So it depends on the cost of those units.
Will you follow up to make sure we're still using those?
Yeah, I'd have to get more information. Is it related to CTE, or is it,
So we,
I need more information on what specifically you are.
they're at the middle school, right? Didn't
Yes.
we do it at the middle school and we did it at ALE? We bought these really nice fancy computers with a really nice program, with a really nice setup. And we could go in and we could dissect a heart and see everything inside of it, from the vessels to the heartbeat to the muscle to the atrium, like all of it involved. And it was amazing. But are we still using it? Is it sitting
don't
there
know.
collecting dust?
I don't know. We can sure find out.
Okay.
It was in the middle school library.
Yeah, it was in the middle school top second floor of the library. And then I remember it being at the ALE, and then I think we bought virtual glasses for ALE. Do you remember that, Rochelle?
Do you have just one more question. Do you have a general idea on the time frame of that? Was that 3 years ago, 2 years ago, 5 years ago?
No, that was like it was right before COVID.
Okay, so around March of 2020. Okay,
What is
sure.
2020?
I think it's, yeah.
2019?
Well, it was,
We'll be happy to,
it's a little over 2 years.
we'll do some research.
Okay. I just out of curiosity about that.
Sure.
Okay, cool. Sorry. Sidebar.
So, that's all right. So, let's look at our expenditures by account summary. So 61,000 are all salaries, 62,000 is all fringe. Salary and fringe, biggest portion of our budget. For FY '22, we have 60.3 million budgeted for salary. We have 17.8 million budgeted for fringe. That's a total of 78.2 million. So 71.4% of our budget, total budget, is budgeted for salary and fringe.
What all is under fringe?
So that is Social Security payroll tax that the district has to pay, the matching taxes. It is the FICA tax, the Medicare tax, the health benefit that the district pays. life insurance that we pay for employees, dental where we have a benefit for the employee. All of those benefits, the health and non-major health benefits that the district pays on behalf of the employee are in that. Also, teacher retirement. Teacher retirement is 14.75% of the salary line. So the largest portion of that's gonna be your teacher retirement, then also federal taxes that we collect from employees to pay to the IRS, that's in that group as well.
On the teacher retirement, do we pay half or do we match it? Just
We
curious.
pay 14.75% of the salary of an employee to teacher retirement. They pay 6.75%. So a few years ago, the rate was 6% and 14%. They changed the law back when schools started outsourcing a lot of services, custodial, child nutrition, maintenance, and teacher retirement was losing money because if you outsource, if the district's not paying the employee, then that portion, ATRS, was losing a payment that they were planning on. So there was a law enacted that actually raised the teacher retirement contribution rate for the employee and the teacher 1%, but they did it over a period of 4 years. So they raised it by increments of 0.25%. We're in the third year of the 4-year implementation. So this year we're paying 14.75% to, to ATRS on behalf of the employee. And we also deduct 6% from the employee through payroll or 6.75% that we pay to teacher retirement. Next year, that will culminate in that full 1% increase that the law allowed. So employees will pay 7% next year and we'll pay 15%.
Wow.
So that's, that line it includes a lot of benefits, and it also includes, but what we have budgeted there is what we're budgeting, the benefit part we are paying on behalf of the employee. The deductions are kept on the balance sheet. So as we deduct things from employees, that sits on our balance sheet. We just pay, we're pass through on that. But these funds here are for the district cost for benefits that are paid on behalf of the employee.
How much is it classified on here? I see classified retirement. Is it the same rate?
We can look at that. I actually have a document in just a moment I can share with you, and we can look at that. This is a total, all salary,
Okay,
and that 62,000 is a total all fringe, but we can look at what those totals are. So again, 71% of our budget is salary and fringe. And let me make this point. So before the refinance, we were paying roughly 13 million on our bonded debt payment. So 13 million out of a $100 million budget is an additional 13% for your bonded debt payment. So the 71% plus the 13 was 84%. 84% of your budget's locked in. Now we refinanced and we have a different pay schedule now. We have a lower interest rate, and we're paying only interest on that for 3 years, so we can bank some dollars for our building fund. So I'm going to go over that with you in just a moment and show you how that's being budgeted. But the point is, in a $100 million budget, there's not a lot of leeway or discretion for funding to be able to pay for additional services. You have to, you have to plan, you have to budget those. Okay, so here's just a graphical representation. The 71.4% of your budget is salary and fringe. The other 28% is your other expenses. And then here is a summary by category. So the first line is, again, your salary, 61,062 is your 17, and there's your 71.4%. $63,000, 4 and 5, those are all purchase services, and you can see that those are services, professional services that we purchase or utilities that we're purchasing on behalf of the district from outside entities. That's 7.3% of our budget. Materials and supplies, 8.3. Capital outlay, items that cost more than $1,000 each, we've got 2.1 million budgeted. Now that could increase. So again, I told you at the beginning, the budget is a living document. So we met with principals. They told us how they would like to budget their money. They said, I'd like to put X number of dollars in teacher supplies, X number of dollars in general supplies, X number of dollars in travel. But if a teacher comes to them and says, hey, I'd like to have a specialty item, and I want to buy that, if the principal agrees, the principal sends us an email and says, hey, move some money from one account to another so I can make this purchase for the teacher. So these numbers move and fluctuate all year based on the need of the school and department level. So it's a living, breathing document. But this is a snapshot as of today that you all are looking at. 66,000 materials and supplies, 9.1 million. And I can tell you that a lot of departments and a lot of programs use materials and supplies as a holding place. So if they haven't got their whole year mapped out, but they know that there might be some things they want to budget, they'll budget their excess money in the 66,100, and that'll be their go-to spot during the year when they need to move money for special purchases. So this money right here will probably get dispersed throughout the year to different areas, but that's where it sits as of now. 67,000 to 2.1 million. Other objects, dues and fees, penalties, those things, there's 4.1 million. Now I'll say that this 68 and 69 is where the bonded debt payment comes out, okay? And you can see we've got, let's see, we've got right at 12 million budgeted there. Part of that is going to your payment for the bonded debt, and the other part of that is going to the building fund. We're scheduling that transfer to the building fund to save that money, and I've got some information on that for you here. So I've got a link here. Let's click and look at this, and you have this in printout form if you're not looking at it electronically. So this is the document, if you recall, that back where we went line by line in the different categories of funds during the spring and looked at the budget. This is that same format. So all of the 6-1s, you'll see here in this account column, all the 6-1s are salary. So let's just look through there. Let's look at the first line. So 6-1-1-1-0, certified salary. I'm not gonna go through every line of this. I'm just gonna point you to some highlights. I'm just gonna point you to some highlights, okay?
Yes.
So certified salary,
We'll be here till tomorrow.
you'll see that in FY22 budget column, this number right here that I'm pointing at, 39.3 million, is what we have budgeted for certified teacher salaries. So anybody that's certified who's being paid under contract is their salary is being budgeted there. The next line, classified, is 15.7 million. So those first two lines make up the guaranteed contracted amount for employees. If you'll notice, the next two lines are temporary. Those might be temporary employees that we hire and pay through the district. The next line is overtime for classified. Certified doesn't qualify for overtime. Classified does. And most classified, there are some exemptions to that under the Fair Standards Labor Act. Then additional compensation is when people do additional duties. If you have a teacher that covers a class during their conference period, or they're teaching more, if you have a secondary teacher that's teaching more than 150 kids, we have to pay them that prorated amount over for each kid over 150. That's in Arkansas law. If you have a teacher that works on their lunch period, they don't get an uninterrupted lunch and they agree to work, that'd be an additional duty. You might have somebody that's covering an after-school detention hall, or after or Saturday school, or working after-school tutoring. Any of those things would be under the additional compensation. The next two lines are where it says workshops. That's where we pay certified and classified people, employees, to attend workshops. So we may pay them an additional stipend to go. Now the certified subs and classified subs, those are temporary subs that we bring on and we pay through payroll. There won't be a lot of that here. That may be a substitute nurse, specialty areas where we can't pay those spots through will sub. We may need a substitute. Last year we needed a substitute assistant principal. Last year we needed a substitute guidance counselor, and last year we needed a substitute 504 coordinator.
So
at
kind
a
of almost like
particular-
contracted work.
So we're bringing them in. They're not gonna be a full-time contracted person, but they're on a temporary basis, and we pay them. That's where these things are paid here. But our normal sub costs are not paid in the 6-1s. Okay, and then the next two are certified unused sick leave. You'll see there that both of those are certified. One says no separation, the other one says separated. So we pay employees, if they're not separated and they have over 100 sick days, we buy them down to 100 sick days annually at the end of the year if they don't use them. And if you retire and you meet the policy in retirement, if you're retiring through Arkansas Teacher Retirement, you meet the policy requirements, then we buy all of your unused sick leave when you retire. The next two is the same thing for classified, the unused, no separation, and then early retirement, that is our longevity. So you have a longevity line for certified and a longevity line for classified. So again, I just wanted to step you through and refresh your memory on the salaries, but all of those, so if you'll notice here that 78 million, this whole line here, that's where we have budgeted our salary and fringe. And then below this line, we have our other expenditures. So all the 63 are purchase services. So if you'll notice there, we've got substitutes. You see line 6322 and 63221, 63220, 63221. Those are substitute purchase services. That's where we pay will sub. So for certified, we have budgeted $704,000 for this year, and for classified, we have $563,000. So we have $1.2 million scheduled in substitute. Of course, legal comes out of here. That's a professional service that we buy. All of our audits that we use, that's in there. Software maintenance down in the 63.5s and 63.9s. Those are all professional services, drug testing, software license renewals, maintenance and support. All of those items are just examples of purchase services. Then we get into the utilities. We have water and sewer, and then down we get into the travel and 65s, 65,000s. And then in the 66, that's all the general supplies. 67s are the greater than 1,000 equipment items, and then 68s are the dues and fees. So what I'd like to do is scroll down. If you'll notice here on my screen, I've got a little link here on 3 different lines, and it's the link to the same document. And it's a link to Scott Beardsley's final summary of our bond refinance. And if you'll look behind this page, the state aid notice, page 2, it says debt service comparison. That's from Beardsley Finance. So I'm going to click this and put it on the screen. And this is the final document that was sent to us after the refinance. I thought I could. Oh, there it is. Okay. So you'll notice that the highlighted lines that I have are applicable to FY '22. This will be the first year where we realize savings on the bond refinance that we get to move to the building fund at the end of the year. So he's got the savings listed there, which there's 3 different issues there. We actually now have 2 bond issues. We have a refinance and one that hadn't matured. I think it's now reached maturity. We could actually may refinance that one, may bring that to you at some point whenever it reaches maturity. But our fiscal total savings for this year is $7.95 million. So of the $12 to $13 million that we were scheduled to pay in a bonded debt payment, we're now going to save $7.9 million on that because we're paying only the interest. And you'll notice that for the next, I believe here, maybe the next 3 to 4 years, we're paying only the interest, and then our savings drops down to $1 million until we reach year 9 or 10. So we have savings here. So this is where the savings is going. So if you recall, the $7.9 million in savings that we're just not going to write that check to the bank for a mortgage payment. It's going to stay in our account. We're going to keep $1 million in the operating for operational savings. And then the $6.9 million, the balance of that will get moved to the building fund into savings for future projects. So that, I have that on here so that you can see, decrease that. So that's this line here, 69,330 to the building fund. You'll see in fiscal year 22, we have 6.9 million budgeted to go to the building fund. Now, we'll take 6.9 over, and then if there is an excess, in July, I bring you a resolution that says you approve to move the excess of 12.8 million over to the building fund. If there is an excess for fiscal year 22, that could move as well. So at a minimum, 6.9 is going, and then if there's an excess at the end of the year, there is, that will go over as well with your approval of that resolution at the end of the year.
All right, Mr. Brown,
Yes.
is now a fair time to ask
Sure,
a question?
sure.
Okay. Before we move on past the expenditure sheet, so you're right where I want you to be. I have one concern about this, and it's sort of like this looming thing that's gonna get us, and here's what I wanna ask. So, if you look at the salary and benefits total, we've been creeping up for the past 4 years, about 2 million a year. Now we've lost 450 students. The hope is that some of those come back, maybe all and more come back, but we certainly can't assume that's gonna happen. Unlike some folks, I don't assume the best case, I wanna look at the worst case. So, we've got that. And then we've also got a virtual academy that doesn't even fall under the umbrella of salary and benefits, correct? It falls under the umbrella of services,
Correct.
okay?
Correct.
So that's an additional expense because of kids that are virtual. Eventually, we're gonna have a problem. And if the kids don't come back, we're being compensated for 50% of our lost student enrollment in year 1, but that doesn't continue. We're gonna have a real issue. Are we making plans for that? Here it goes. I don't wanna let a teacher go. So, ever. I've been through that and it's not any fun. And, I don't wanna do that. And I want to make sure, we always like to say, we want to see it happen through attrition, through natural retirement, folks leaving, and kind of have a plan for that to get us to this point 2 or 3 years down the road. Because I don't want to get there and then be short $10 million and have to make very, very difficult decisions. So do we have a long-term plan to deal with the hope is that we turn the ship around and our student numbers come up. But if they don't, we got to be ready for that. Because I've seen a lot of kicking the can down the road going on the last 10 to 15 years in this district, and it's not you, It's been largely on board members like myself, and I'm probably guilty of it myself. But it's like, we have to face reality because eventually we're gonna have to. So what's the plan to deal with this? Is there one in place? Is it being discussed?
Thank you for that, Mr. Zakreski. The short answer is yes. And so one of the things that we're working on right now as we speak, we've got all of our principals are getting ready to do their budget presentations within the next month to the executive team. We're looking at every teacher. We're looking at all of the resources, the human capital resources that we have at the school and central office and everywhere else. That's one piece of data. The second piece of data is going to be from the Gibson Consulting, which is one of the things that we've asked for. But you're exactly right. We have a teaching staff here, but we have a student enrollment component here. And so we're going to have to, as we look at all that and look at that line by line, we're going to have to make some difficult decisions. We're looking at class size. Right now, I was just in a meeting looking at our high school classes and how many students are scheduled in our courses. Student enrollment has to drive certainly the decision making. That we're going to have another challenge, which is eventually when we get to a compensation study and looking at what teacher salaries are being paid throughout the district, our surrounding areas who we're losing to, or not losing to, but where we might be losing some candidates to. That's another factor when we look at, longevity of our teaching force as well. That's another caveat to this as we move forward. But the bottom line is enrollment is enrollment, and I think that's going to be certainly our challenge is reversing that enrollment and increasing. I envision your comment about Pearson. We knew that was kind of a short term. So we know when we kind of move that forward, we're going to phase out of paying for that service, meaning having Arkansas certified teachers, because I believe we can do that. We're just not ready for that. So I think there's a lot of dynamics around this, but it has to start, one, with getting our hands around our human resources and human capital.
Well, you said student accountant teachers. I assume that administration and administrators are going to be part of that evaluation too, right? I mean, we're going to be looking at that and make sure we're not too top heavy. And I'm not saying we are. I'm just saying we need to do it top to bottom.
Right, and so one of the things we're also looking at too is what we don't have in place is we don't have any staffing ratios. So which we can, are more or less like guideposts, right? Whether that's at, principal level, assistant principal level, guidance counselor level, teacher level, all those things. So yes, they're very much a part of, and that's why we're having the principals come in and do one-on-one presentations with us to, number one, talk about the needs of their school, what it's going to take to move forward, what are their needs, and the conversation that they're having about, for an example, we just a couple weeks ago, we saw some, an increase in enrollment at one school, but a decrease in the staffing didn't justify. So we're making those internal moves when we can. To be able to justify the enrollment, and certainly in trying to maintain low class sizes as well. But, if we just have to have a serious conversation, because I'm looking at some numbers today where we might have some high school courses with 2 students in it. So those are things in which we've got to take a look at more closely and then make some decisions, because I'm not convinced we're using all of our human capital to its effectiveness.
Well, I know we do, but there's not teachers teaching some of those courses. Some of those are sort of student self-driven courses too. But I agree. I mean, I agree we got to make, the offerings have to match the supply and demand has to match up.
Sure.
Okay. I just want to make sure, and when I say top to bottom, I mean central office down to the schools. And I don't want to hold the principals' feet to the fire and make them atone for things that they haven't done. So
absolutely. I mean, my last comment to that is, we've got to look at staffing across the entire district.
Yes.
And because the bottom line is the ultimate, my position of this is to protect the classroom first. That's always the first piece that you want to protect. Mm-hmm. But we've also got to look at enrollment, class size, so forth.
All right. Thank you.
Yes, sir.
I have a follow-up question, if we don't mind. So we went back to where the principal has their budget, and then you had said something about material and supplies. So with that being said, where would say, if I'm a teacher at the high school
and I want a new, say, social studies or civics book, textbook, does that come out of that? Or does that come out of, where does that lie?
There's
Cause
a-
I see textbooks here.
Yep, there's a textbook line.
Okay, so it would come out of that.
There's also
text-
an e-textbook line.
Right,
And that's a good question. I think where we're gonna have to get to in the future is do some future forecasting. Because many of our resources, are either teachers don't have or they're out of date. And so we're gonna have to make some decisions because we wanna make sure that everybody, it's back to this viable curriculum, aligned instructional resources. So we just don't want folks to purchase stuff. But if they have a recommendation, that is to go through, their principal. And because those departments, I believe, Mr. Brown, correct me if I'm wrong, do have,
Directors. So it'll go through if they have a curriculum request, it goes through the principal and then to the appropriate director. And then the director, the textbook lines they do not impact the school level budgets. Those are district funded budgets.
very good.
Okay, now, you'll notice, the lines that I've highlighted on the screen are all textbook and library book related. In fiscal year 22 and 21, the budgeted and actuals are much lower than in 19 and 20. That's because we were able to use ESSER funds to supplement and get our needed curriculum for learning loss. So ESSER has,
Definitely help.
has done some help there,
It's
and we've been
benefited.
able to get some things that we've needed for a while. So,
Okay,
yes, good question.
cool.
Okay,
Just trying to figure out the line.
yes.
yes, ma'am, I agree.
Okay, and then the second link here is just a summary. Again, this is budget to actual for 19, 20, 21, and 22. But these totals, the budgeted 109 million, that's right here. We've actually spent 18.1 so far this year, and we have 91.3 left in our budget balance. That's where I got these numbers from that total there. Again, I think this is the next to the last slide, so just a total expenditure graph representation. Salary and fringe, just a refresher, 71.4%, and then all the other categories are much smaller expenses, but it's part of our overall budget. And that's my budget presentation. I'll be glad to answer any questions that you may have.
Where does the money go hypothetically? What happens if we have extra money? So would you come to us, so say hypothetically, Board of Education Services, $6,407, we'll just use it. So say all of us board members were lazy, we didn't go to any EDs, PDs, and then, so where does that money
So
go?
the board's budget is in Fund 2, which is our operating budget. So every dollar that's saved
Stays there.
stays there, and if the operating budget balance exceeds 12.8, in July, you all give us permission to move the excess
To
to
save
the
it.
building fund, and it stays in the building fund until you authorize expenditure from the building fund. So every dollar saved stays in operating unless there's a surplus above 12.8. And if it's a surplus, it goes to the building fund, it stays there until the board authorizes an expense from the building fund.
And the federal funds we have to spend or we lose them.
That's correct.
So
There's
that's
a-
first and foremost of what we spend
That's,
first.
that's correct. There's a
Yeah.
carryover limit.
Yeah.
So we are required to spend a certain percentage of that or you lose it. But we don't have a problem with that. We don't have excessive carryovers. We're utilizing our federal funds,
Okay,
very efficiently. So,
okay.
yes, there are some federal funds like RMAC that are what we call cash accounts. We get the money and it stays in there. It's like a bank account, so we record it to RMAC. There are some funds that are like Title I, that you have to spend the money first, and then you apply for a reimbursement from that. So you have to have the financial resources to pay a salary and fringe, or to buy curriculum, or to have, you have to be able to front the money for the purchase or the salary. But then on the back end, we apply for a reimbursement and ADE reimburses us. So there's two different categories of federal. One's reimbursement and one is what we call a cash account.
So the reimbursement on the federal, is that how we did some of the improvements, the capital improvements and the building? It seems like we had to like front the money and then we had to like apply for grants and reimbursement. Am I
Well,
remembering
there
that
are-
correctly?
So yes, there's a different funding source for
Okay.
state match.
Okay,
And that's what the process that you all are going to look at on the new middle school. You have to have a planning document, it has to be on file with ADE, you have to qualify with certain levels of
Right.
facility age and need
yeah, points.
to get those
Yeah.
points, to get
Yep.
to get matching state money.
Mhm.
And when the state gives us matching money, it goes into Fund 3. And so, yes, that's one of the examples. During our construction phase, they didn't give it to us up front. We had to pay it out of our construction, and then we have to send them payment receipts.
Yep,
They audit and reimburse us based on, so there in the construction, we had to front that money, and they reimbursed us. But
okay,
it wasn't federal, it's state money for the
Okay.
building program.
okay, all right.
I just had a statement. I just want to say thank you. It's good information. Some of the budget workshops we've had along the way have been slogs, and I think that they prepared us well for this, so thank you.
Okay, I just have one quick question, because you had broken out the revenue with ESSER funds and without ESSER funds. And then I'm looking at the expenditures, which I guess are not broken out that way.
That's correct. Those
So we
include
have-
ESSER.
We have, 100 and, I'm gonna round up, 110 million in expenses, but without ESSER, we're at 98 million in revenue, so that's an $11 million shortfall. Of course, with the ESSER,
We're-
we're really in good shape, but,
We're projecting $10 to $11 million of expenses in ESSER 2. We're finishing up ESSER 1, so ESSER 1's history, it's gone, was depleted. ESSER 2 will be depleted this year. We'll begin ARP ESSER. So we will end up budgeting this year around $10 to $11 million. So the expenses, the overage and expenses that you're seeing are attributed to the ESSER
okay,
funds.
okay, all
Yes.
right, thank you.
Yes, ma'am.
Okay, and I thought I was done, but Ms. Temple made me think something new. So those $10 or $11 million in ESSER funds, these are not continuing expenses, I hope. I mean, I guess we're not spending money on things we're still gonna have to spend money on when the ESSER funds go away. Is that the right way to ask that, or do we know how we're gonna adjust once that money goes away?
So I'll answer that. The answer is yes and no. So we do have human capital that is hired out of ESSER. So at some point, we'll have to decide whether that continues or not after ESSER funding is depleted. So it may be that we may not need a point of contact when COVID is gone. It may be that we need to keep a virtual academy director. We may need to continue that service even after COVID funds are left. So that's gonna be a decision with executive team and the board. You know, all that'll come through you all, and you get to, you know, those are decisions that you all get to make on what we continue and what we don't. There are some expenses that are one-time expenses, you know, like PPE. That's one-time expenses that obviously wouldn't carry on past, you know, COVID or ESSER funding. So the answer to that is both yes and no.
Thank you.
Thank you, Mr. Brown,
Yes,
very
ma'am.
informative.
Thank you.
Mary and Deb,
Are we
And
ready to
understood.
go into a meeting and vote on this budget?
call the order.
Okay, y'all ready? Any other questions? Okay, call a special meeting to order. Can we have a roll call, please?
Ms. Temple,
Here.
Dr. Redis.
Here.
Ms. Walken,
Here.
Mr. Zakreski,
Here.
Ms. Parson West,
Present.
Ms. Williams, and Mr. Steele.
Thank you. Madam President, and members of our Board of Education, the superintendent recommends action item 3.1, the 2021-2022, or also known as FY22 budget, as presented at our recent workshop.
Madam President,
I so move that we accept the action item of new business, the 2021-2022 budget.
Second.
Okay, it's been moved and properly second. Is there any discussion? Okay, all in favor?
Aye.
Any opposed? Motion carried.
Thank you.
So we have future meetings, the workshop on October 7th and a regular board meeting on October 21st.
Madam Chair, I move we adjourn.
Thank you.
Thank you, Mr. Brown.